This video is created by Jagrat Creations. It is on joint venture accounts. I want to solve one sum wherein Memorandum Joint Venture account is required to be prepared. Memorandum Joint Venture account is a statement prepared to find out the profit for joint venture business. The statement is prepared on the basis of matching concept. This type of statement is required to be prepared when no separate independent books of accounts for joint venture are maintained, and in that circumstances also every co-venturer or a partner records only those transactions with which he is concerned, with which or the transaction to which he is a party to a transaction. Now observe the sum that I intend to solve here before you. This is the sum that I intend to solve here before you. This sum was asked by the institute in one of its examination. A and B decided to work a joint venture for sale of electric motors. On 21st of May 2016, A purchased 200 electric motors at 175 each and dispatched 150 motors to be incurring 1,000 as freight and insurance charges. 10 electric motors were damaged in transit. On 1st of February 2017, Rupees 500 was received by A from insurance company, a full settlement of the claim. On 15th of March 2017, A sold 50 electric motors at Rs 225 each. He received 15,000 from B on 1st of April. On 25th of May, B took the delivery of electric motors and incurred the following expenses. B sold electric motors as below: 10 damaged motors at 170, 40 motors at 200, 20 motors at 315, 80 motors at 250. Now 80 plus 20, 100, 100 plus 40 and 10, 150. These are the 150 motors are sold, and here 50 electric motors are sold at 225. So 150 plus 50, 200 motors are sold, 200 motors are purchased. So all the electric motors that has been purchased has been sold, so the business is concluded. Now, prepare. It is agreed that they are entitled to a commission of 10% on the respective sales affected by them, and the profits and losses shall be shared between A and B in the ratio of 2:1. B remits to A the balance of money due on 30th April 2017. Prepare necessary accounts in the books of A and B, and also prepare Memorandum Joint Venture account. Now first of all, I will start with the books of A. These are the details of the sum that I have read before you. In the books of A, he prepares joint venture with B account. A is going to record all those transactions with which he is concerned. That's the only principle. Now the first transaction, they are going to share the profits and losses in the ratio of 2:1. So I write at the top, A purchased 200 electric motors. I am A. I purchased for joint venture business 200 electric motors. I have made a payment for that. So cash or bank account is to be credited in my personal books of accounts. This account also I have prepared in my personal books of accounts. So in my personal books of accounts, cash and bank account is credited, and this joint venture with B account gets debited. So joint venture with B account debits 35,000 to cash account credit 35,000. Expenses paid by me 1,000. I have paid expenses, so cash goes out, cash account is to be credited. The expense is paid for joint venture business with B, so this business is receiver. So debit the receiver to cash account, expenses paid. So this 1,000 expenses will be debited to joint venture with B account. The most important point that I want to emphasize is now, dispatch 150 motors. So I am A. I have given 150 motors to B. Now when I purchased the motors, who was the owner? I was A, means I was the owner? No. A and B both are the owners, Because the motors are purchased for the joint venture business. And when the purchases are made for joint venture business, the ownership of the goods based in the co-venturers partners. So the motors purchased are owned by A and B. So motors are purchased though by A, but the ownership of the motor is of A and B. And when such motors, some of the motors are transferred to B, there is no change in ownership. So 150 motors sent to B for selling. This transaction should not be recorded in the books because it is not a transaction at all. It is just a transfer of possession. And when there is a transfer of possession without change in ownership, no transaction could be recorded. So no transaction, not recorded. This transfer of 150 meters not recorded as ownership has not changed. But the expenses incurred or the expenses paid by A, cash goes out. So cash account is to be credited and joint venture with B account is to be debited for 1,000 rupees. So joint venture with B account debit 1,000 to cash account credit. Now 10 electric motors damaged in transit. Now this damaged in transit, 10 electric motors damaged in transit. I am going to record only those transactions with which I am a party to the transaction. So not recorded because it is not a transaction between A and joint venture. Motors damage. The ownership is lost by joint venture business. It is not a transaction between A and joint venture business with B. It is an event. So this I don't intend to record. It cannot be recorded. Now 500 rupees are received by, so I got 500 rupees cash account debit to joint venture with B account credit. This 500 received insurance claim that will be recorded to the credit side because I got this 500 rupees because I am a partner, or it is I have received this amount from a joint venture business with B account. So I got cash and bank account debit, joint venture with B account credit. Now A sold 50 motor cars at 225. I got the cash and bank account debit to joint venture with B account credit 11,250. Now I also he received 15,000 from B. I am A. I have received from B. So I am A. I got cash and bank account debit to joint venture with B account credit 15,000. Now on 25th of May, we took the delivery of the motors and paid these expenses. All these expenses paid by B is a transaction between B and joint venture. It is a transaction between joint venture and B, not recorded in the books of A. B sold all these motor cars. So all these sales revenues collected by B for joint venture, it is a transaction between B and joint venture. B receives sales proceeds for joint venture. It is a transaction between joint venture and B, and hence not recorded in the books of A. Now 10% commission to which I am entitled to on the sales made by me. So 11,250 into 10% is a commission. I am entitled to have a commission. Commission is my personal income. All this account is prepared in my personal books of accounts, and commission my personal income. I am going to credit commission account, and this commission is recoverable from joint venture with B. So joint venture with B account debit to commission account credit. Now same way commission is payable to B for the sales made by him. It is a transaction between B and joint venture, not recorded. Now after recording all these transactions, A claims his share in joint venture profit. Memorandum Joint Venture account is prepared to find out the share of A in profit. Now I prepare Memorandum Joint Venture account. It is a statement. It looks like an account. In account, this is a debit side, but actually this is not the debit side because twofold effects principle is not followed. The accounting dual aspect concept is not followed. But it is prepared on the basis of matching concept to find out the profit of joint venture business. So all purchases and expenses will be recorded on this side. Sales revenue and insurance claim received will be recorded on the opposite side. And on the matching of this expense with revenue, we will find out the profit. So purchases 200 motor cars. Expenses incurred Now, damaged motor cars realized only 500. So it's a revenue wherein loss has occurred. And by matching, loss will automatically be accounted for. 50 motors sold. This is the sales proceeds of 50 motors at rupees 225. These are the expenses paid by B. So expenses are recorded on this purchase and expense side. This is the sales revenue that B got, but it is an income of joint venture business. So this total 170 into 10, 1700, 40 into 200, 20 into 315. These are the sales proceeds. Total sales proceeds 36,000. It is recorded on the revenue side. These are the revenues. Now I am required to pay 10% commission on the sales. So 11,250 into 10%, 1125 commission income, personal income of A, but the expense of joint venture business. 36,000 into 10%, 3,600 is the expense of joint venture business. Of course, personal income of B. Now, I have recorded all revenue and expenses. By matching revenue and expenses, I'll find out the profit. So 47,750 minus all these expenses. The profit 6,000 distributed in the ratio of 2:1. So 4,000 and 1,000. Share of A is 4,000. Share of B is 2,000. I am recording the books of accounts of B. I'm recording the books of accounts of A. So I'm entitled to have a profit of 4,000. So joint venture with B account debit 2. Profit and loss account credit 4,000. Now after recording this profit, I should go for settlement. So these are the payments made by me, or profit and commission to which I am entitled to is also recorded. From this total it will be deducted. So you will get the amount to be recovered in settlement. So 41,125 minus these three items, the amount to be recovered is to be received in cash. So cash and bank account debit to joint venture with B account credit 14,375. This is how transaction gets recorded. Only those transactions are recorded by A with which he was concerned. He has not recorded the transaction between joint venture and B, and he has also not recorded the events. But this memorandum joint venture account is found out to find out his share in profit. Now on the basis of same principles, if B records how the books of accounts will appear, that I want to start. So now I am going to prepare in the books of B, joint venture with A account. Now first transaction, motors purchased by A. It's a transaction between A and joint venture. A contributes for joint venture. It is a transaction between joint venture and A, hence not recorded in the books of B. Expenses paid. These 10 electric motors were damaged, not recorded because it affects both debit and credit side of joint venture. This is not the good reasoning. It is not recorded because it is not a transaction between B and joint venture. Now A receives the proceeds. It is a transaction between joint venture and A, hence not recorded in the books of B. 1,500. He receives 1,500 from B. So I am B. A receives 1,500 from B. So I am B. So I pay to A. So that payment will be recorded on the debit side. Joint venture with A account debit to cash account. These are the expenses paid by me. So cash goes out. Cash account is to be credited and joint venture with A account is to be debited. So joint venture with A account debit to cash account. So these are the expenses paid. Now the sales proceeds received by B. Cash or bank account debit to joint venture with A account credit. Cash and bank account debit to joint venture with A account credit. I got the cash. Cash and bank account is to be debited. And all these sales proceeds I received because of my joint venture business with A. So A is the giver. That is the presumption. So cash and bank account debit to joint venture with A account credit. Same way 80 into 1, 250, 20,000. Now I'll record the commission to which I am entitled to. Total sales 36,000 into 10%. This commission is my income. that is to be recovered from a business of joint venture with A account debit to commission account credit. Now, I am B. I have recorded all the transactions with joint venture. At the end of the day, on sales of all motor cars, I want to have my share in profit. So B claims his share in joint venture profit. For that, memorandum joint venture account is to be prepared. No need to prepare once again the memorandum joint venture account because it is already prepared by A and A must have sent that joint venture memorandum joint venture account to B. So no need to prepare. But as a matter of academic interest, I prepare here before you. So purchases are debited. Matters little whether the purchases are made by A and B. Expenses are debited. Debited means recorded in the expense side. Actually, this is a statement. It doesn't have debit and credit. As we understand in dual aspect principle of double accounting, double entry bookkeeping. But this is the expense side. For the purpose of explanation and understanding, I may say this is an apparent debit side. This is the apparent credit side. So expenses are debited. Insurance claim received. Revenue side. Sales proceeds of motors. Expenses paid by B. Recorded on the expense side. Sales revenue 36,000, as you know. That is recorded as revenue. Commission is to be debited. Means recorded on the expenses side. 11,250 into 10%. Similarly, 36,000 into 10%, 3,600. Now we should find out the profit. 47,750 minus all these expenses for the joint venture business, we will get the profit. That is going to be shared in the ratio of 2:1. So my share being B, 1/3. So that is 2,000. Joint venture with A account debit to profit and loss account credit 2,000. Now the account is to be settled. So you have to compare the debit and credit. So total of credit side minus total of debit side. This is the payment to be made to A. So B makes payment to A. How much? 14,375. So joint venture with A account debit to cash and bank account credit. And if you remember, we arrived at the same amount when we recorded these transactions in the books of A. So this is the whole sum that I have tried to explain to you. I feel that you have followed all these things. Thanks to